Fausto Pugliese, president of Cyber Trading University.
Most people always focus on the past, where as a professional day trader, we just focus on the future. You can do very well in trading, and you don't have to have a good amount of movement for the stock to go up.
Welcome, everybody, back for another episode here at the podcast here at Traders, where we bring them in and try to introduce you to all of you and kind of understand what's going on in the market. And today I'm really excited because usually we bring so many speakers as a lot of gurus and, all time psychology, everything. But today is a different one. We brought an accountant. And I know a lot of you here have so many questions regarding about, how do I pay these taxes? How do I, what am I allowed to do? What am I not allowed to do? So we had Traders Accounting on, as long as I could think of, we had them. I've been doing this for 30 years. I think as long as they've been around, I always had them here at Cyber Trade University. And I know it's one of our most popular, events that we do here. So I want to introduce Jerry Allison here. And Jerry, thank you so much for being here. I know we have a lot of students that are looking so forward to questions to ask, like, what the hell do I do? If you're making money, if I'm losing money, what can I write off? Because you know what is, Jerry? A lot of people don't understand that, like, your accountant is not a trader. They don't understand these rules and everything else. And I want you to put some light on it. So tell me a little bit about yourself, Jerry. What are people doing wrong?
Well, that's an interesting question to start off with. There's a lot of misinformation out there. For one thing, they believe everything that they read, and that's one of the things that we go back and correct, is to try to get things set up properly. Some people will set up a C corp and think, oh, that 21% tax rate is great. Well, there's pitfalls to that. Some people will set up a single member LLC, and it doesn't solve anything for them. So there's a lot of different pitfalls that people have. Mark to market election is another pitfall. Not that it's a bad thing, but there are very few accountants in the United States that actually know how to compute that and actually work with it. So there's a lot of pitfalls out there. So don't believe everything you read. But again, I would encourage you to read a lot, just to compare things and listen to podcasts such as this one.
Yeah, and that's why I wanted to have you on, because, like I said, we have people from all over the world that are logged in, that are even going to be watching it right now. And I know rules are different, especially we have a lot of Canadians here, and they're like, "Oh, I want to open up a U.S. account." Everyone's always asking me, "I want to start trading, but I gotta, do I open up an LLC first?" Or they want to take our classes at CTU, and they're like, "Well, can I write it off?" and stuff like that. I guess I always learn that you're doing this as a business. Right? It's a business. So technically it's not, and some people, like accountants, think like, oh, you're going to have to get 1099 yourself or whatever. You got to pay capital gains. It's all different. So regarding about Traders Accounting, tell me a little about Traders Accounting. I think everyone needs to know a little bit about like what brought you guys into this business, and how did you change people's way of running their accounting?
Traders Accounting has been around for, probably at least 2 decades now, possibly longer. I wasn't around at that point, but it's been around for a long time. And the reason it exists is that the founder saw a niche, that there were places where people needed tax planning, they needed tax preparation, revolving around trading, whether it was trading stocks and options, or it's trading Forex, or whatever it is. And that becomes a specialized knowledge, particularly with certain pieces of the IRS code where you're trying to deduct expenses, or you're trying to use the mark to market election. Then you start getting more granular. And so that has been the focus of Traders Accounting, is to get in and try to help traders set up, as you referred to it, a business, if you will. Not necessarily an LLC, but set up their business so that they can deduct those expenses, and they can take or actually get the minimum in tax. Let's put it that way. So that's why we exist. And so that we are out there. We've got probably well over 1,000 clients. I'm guessing, because I don't know, but I've done almost 800 tax returns this year already, and
Wow.
It's phenomenal, the magnitude of people we reach out. But I also talk to, a lot of clients. We do consulting, and I consult with them on a not quite a daily basis, but regularly. And then they tell me in a lot of cases that their CPA in their hometown, they've been with him for 20 years. He doesn't know how to handle, or he or she doesn't know how to handle the trading aspects, or they've been with this person doing their taxes. They've been doing their taxes, but now they're going to do the mark to market election. They don't know what to do. So that's why we exist, is actually to create the help that traders need in their tax system.
Now, could somebody have? I mean, listen. Some people like they swear by their accountant. They say it's almost like their uncle. You know what I mean? Whatever it is. Could they use you and their accountant, or they have to leave one to go to the other?
Oh, that's a great question. I get that all the time. If you just have a single return, like your personal return, it is better to have one person do that than multiple people. And the reason for that is, at the end of the day, some CPA or whoever's doing the tax return has to sign off on it.
Right.
And they don't want to sign off on somebody else's work.
Right.
So if you're getting your Schedule C done, let's say by somebody else, and you're bringing it in to another person to do the tax return, that person you're bringing it into doesn't necessarily want to sign off on that, because they have to swear that that's correct.
That's correct. Yeah. Yeah.
So that's not a great situation. However, if you've got like a partnership or an S corporation or a C corporation, uh, we can do those returns, and then you can have your personal accountant do your personal return if you like.
Okay. Okay.
That's an option, certainly, or we can do it. But yeah, there's lots of options here if you've got two entities, such as yourself, as well as another as a business entity.
Okay. Now, what is a fair amount of money that as in like profits or like is it no matter what kind of trader or if you're doing this, because we have, how can I reiterate? Like we have a lot of traders that are between the age of 50 and 90, right? There are a lot of them are retirees and so on.
Mhm.
How does that work with their IRAs and their with the traders? How do they pay taxes on that? Like is it still going to be a capital gains, or is it going to be more of a, do you still have to open up like, do you have to open up an LLC? Do you have to open a corporation to do this, to get the write-offs? I mean, if they have these, I know so many questions here, but
Yeah, that's loaded. Well, let me deal with the IRA issue first. It is possible to trade in an IRA, a Roth IRA or traditional IRA. And that's not taxable, obviously, and it grows. With a traditional IRA, you don't get taxed on that until after you start taking distributions during retirement or whenever. The Roth IRA, that builds up, and you don't pay tax on the appreciation at all, because it's based out of pre-tax dollars. Um, as far as what we don't deal with the IRA issue so much, because it's self-contained. So there's no
okay,
real issues for that. So we deal with the cash accounts, the stuff outside of the IRAs. Now, if you're wanting to deduct expenses, if you're wanting to treat this as a business, then we do have there is a set of criteria, if you will, that have been laid out. Now, I'll back up a little bit. Our go-to publication with the IRS is publication 550. That deals with all types of investing. I mean, everything. It's like 80 pages long. You can go get it from the IRS. You just go in the IRS web page and type in publication 550 in their search bar, and it'll bring it right up.
hmm
But at any rate, the criteria for being able to deduct expenses is very vague. The IRS says they want you to treat it like a business, and you need to rely on it in some way, shape, or form. Uh, did my camera just go out?
yeah, you look a little purple.
Purple. Oh no. Well, I'll keep talking. So I'll try to fix it. Um, the uh, the trading. Uh, Good boy. Then let's see. Let's turn it off. Now turn it back on.
Nope, still purple.
Wow. Okay. Well, I'm just going to turn it off for right now, and then we'll see what happens. Um, the IRS established a criteria for, in order to deduct your expenses, of having you've got to treat it like a business, and you've got to uh, rely on it for some source of income, partial or total income.
Okay.
Extremely vague. So what we have to do is we have to go back to court cases to show, okay, under these conditions that this is when you can actually start deducting your expenses based on the court's interpretation of what the IRS has said. And there's three main criteria that have come out of those court cases. One, a person has to be making at least 720 trades per year.
Okay,
Um,
700. Okay.
that's for some people that's a lot. For some people that's nothing.
Got it. Yeah.
I've got clients that make that in 2 weeks, but be that as may be, that's one of the standards. The other standard is got to be putting in. You got to be trading in over 3/4 of the trading days per year. So when the market's open, 3/4 of those trading days, you have to be actually doing some type of trade in. And the idea here is they want you actually showing that like this is a business. You're not taking significant amounts of time off. You're actually treating it and you're putting the time in. And so that's why, you could take a vacation for maybe 1/4 of those days, but 3/4 of them, they want you trading. And then the third criteria is you should be spending 500 hours a year in trading, research, and education. So,
Really?
uh, yeah. So actually, webinars like this one would qualify for that because it would be education, doing your
How they
research.
track that? I mean, like, are they gonna go back and ask, show me all your videos? I mean,
No, actually, that's a great question. The first two, the dealing with the number of trades and the trading days, that's all on your trading statements. You can just
okay.
hand an IRS agent that. The last one is we recommend to our clients that you keep a trading log. It could be on your computer, it could be paper. The format is really not so important, but the importance is that you actually make the effort to record it.
How many
Uh,
hours is that again?
500 hours a year.
That's not really a lot.
No, not really. Not when you think about it, because most people are well, a lot of your listeners and
Um,
subscribers are doing this a lot. They're listening to these podcasts. They're listening to training and education. That's really not a whole lot during the year. I'm gonna try my camera again.
I'm
Nope,
trying
still
to.
purple.
Yeah. I
But
think I
anyway,
just got an alert. Yeah, if you go to your video settings and select a different camera, it might be, that might work if you had a different camera.
uh,
But I'm just trying to figure out how much is that. So if you do 40 hours a week, right?
mhm,
Was that 20?
that's
Was that?
2,880 hours a
Yeah.
year.
Yeah. Okay.
So that's a lot of time, and so it's not that difficult to put in 500 hours. I mean, a standard work week is 40 hours. So you're talking a decent. It's not really that great, but they want you to show that you're putting in the effort
Okay.
into actually
Okay.
doing that. And I'm trying to work with the camera right now, so forgive me.
That's
But
okay.
yeah,
Now, regarding about, all right, so I guess the next question people ask, do you have to open up a corporation to do this to get the tax write-offs, or you could still keep your personal account to do that?
that's a good question too. Uh, you can write it off on your personal tax return if you meet the criteria. Matter of fact, those criteria seem to apply more to personal tax returns than they do to business tax returns. And what I mean by that, the IRS doesn't just want anybody writing off expenses on their personal tax return. They've been very adamant about that for years.
Hmm.
And so these criteria seem to apply more to personal tax returns. So you got to have the 720 trades. You've got to have the 500 hours and time put in. You've got to have the trading days. Now, if you're going to do this on your personal return, then you deduct the expenses on Schedule C and you report your income like you always have on Schedule D or wherever it's been reported. The issue with that on a personal level is that Schedule C increases your audit risk dramatically.
It does. Okay.
Schedule C is the number one most audited form by the IRS. I've been in doing this for 35 years in some capacity in accounting. Every audit, with the exception of one, has revolved around a Schedule C.
So what do? Do you not?
Uh, Well, that's a great question. And what do is you actually get it off your personal tax return. I mentioned a
Okay.
little bit ago when we were talking that a single member LLC really doesn't do anything. It's one of the pitfalls that people fall into. And the reason it doesn't do anything for an investor is it puts it right back on that Schedule C again.
So why do people open them up then? I mean, because everybody's like, "Oh, I got to open up the LLC. I got because a lot of accountants. So tell them that.
Right, exactly. Because there's a lot of misinformation out there, as I mentioned a little bit ago. And the reason for the misinformation is people, they read stuff very uh, loosely, if you will, or not very carefully. And when they do that, they get their own interpretation on there. And when they get their own interpretation, then all kinds of weird stuff shows up on the internet. So you
Hmm.
have to go back to the IRS. I'm still purple. Wait a minute. Yeah, the whole thing stopped. Well, maybe at least black's better than nothing. But okay. So going back to the IRS code, it really is helpful to form those ideas up. And a lot of people don't do that. They guess and they come up with stuff, or they hear things from somebody else rather than trying to get a solid basis. So what we recommend, quite frankly, is don't do single member LLCs. If you've got one, we can convert it. But what you need is either a multiple member LLC, an LLC partnership, or an S corp. And those two entities pull it off of your personal return. And that solves a whole world of problems right there, because when you pull it off your personal return, now you have a legitimate business set up.
Okay.
And so the IRS leaves them alone. The audit rates for partnerships and S corporations is extremely low, unlike Schedule C, which is on the far end, the other end of it. So you get it off, you get it into a partnership, an S corp. Those are pass through entities. Everything still passes back to your personal tax return where the tax is paid, but you eliminate the IRS scrutiny and solve a whole world of problems while you're at it.
Hmm. Now, if can you write off education or any other expenses on the personal side? I know I asked that before, but is it
No, yeah, actually, absolutely. No, on the personal side, you can actually write off anything related to trading. So your education
as
expenses.
long as you're doing the X amount of hours and you get to show
Yes,
that, right?
absolutely. And that's the
Okay.
criteria for writing that stuff off. So your education and any data feeds you might have, or obviously your broker fees. If you go somewhere for education or training, or like you go to the money show in Las Vegas, or whatever, then all the travel expenses, as well as entrance fees, things like that, that's going to be deductible. So there's a lot of things that traders get into. I will tell you another problem with doing it personally is the home office deduction.
Okay.
Um, when you
That's no
trade,
question. A lot of people try to, everyone's working from home.
yes, that's what we found. I think COVID kind of gave a boost to this trading phenomenon. But yeah, people are trading at home. You might as well get a deduction for what you're already paying for. Well, your
Right.
mortgage interest, your real estate taxes, or your rent, or insurance, or utilities. I mean, there's a whole list of things. But when you're doing it on your personal return, there are huge limitations there. On that Schedule C again, which again I've mentioned is problematic. On that Schedule C, uh, the limitations are if you're not making a profit, or if your expenses put you into, let's say, negative territory, then the office deduction really gets limited to a portion of your mortgage interest and your real estate taxes. Everything else gets knocked out, including rent.
Okay.
So a lot of people don't get to use that home office deduction on the personal or the Schedule C. However, again, going back to partnerships and S corporations, that opens up completely. There are no limitations there. Doesn't matter whether you're making money or not. You still get that deduction for those things you're already paying for.
Yeah, because you could pay rent towards that corporation. That would be the deduction, right?
Right, or even just take a portion of your rent that you're paying and use that as a deduction, like an owner contribution in there. So if your office is 10% of your living space, and you're paying, let's say, 2,000 a month, there's $200 deduction each month right there for
Right, right. Now, let me ask you about losses.
you.
I mean, like, listen, not everybody makes money, and
Right.
some people eventually, where they had a bad year, whatever it is. How does the losses work? Because they say you only could you only could book X amount of losses, a year,
Mhm.
whatever a dollar amount. But I know is if you do it as a business, and let's say you lost, I don't know, let's use like simple math, like whatever, $10,000. You lost 10,000. Um, are you only allowed to write so much off on stocks, or you can write the whole thing off?
I'm going to give you the infamous accounting answer. It depends. Um, Under traditional accounting or traditional reporting, if you have a $10,000 loss, if it's a capital loss, then you get to write 3,000 off,
Yes, what
and
I'm saying. It's only 3,000.
yeah, and the remaining 7,000 goes into next year to be used up against future capital gains or another 3,000. However, if you are a stock and options trader, then you have the ability, if you meet the trader tax status requirements that we talked about with expenses, if you meet those criteria, you can make the mark to market election, and in that case, you can write all your losses off in a year. So, in our example here, the entire $10,000 could be written off in that entire year for somebody that has the mark to market election. Now, next question is, when do you get that election, or how can you get it? Well, how to get it is you just simply send a letter to the IRS. Now, we generally, if you read publication 550, they want that put with either your tax return or your extension before the due date of the tax return, which means it's already too late to make it for 2024, uh,
Okay.
for personally. For
Can't you set
2025.
an extension though if you wanted to, or can't you like um, resubmit your tax returns if you want to redo it?
No, it's very specific that you have to make it by April 15th if you're an individual
Okay.
for the year in which you want it to start. If you don't do that, it's gone. It's lost for that year.
Okay.
Uh, if you have already have a partnership or an S corp where those returns are due by March 15th, then the election has to be made by March 15th of next year. There is one exception though, and that exception is for a brand new entity.
Hmm.
So, for example, if you were to start, let's say, a partnership or an S corp this month, and you go ahead and get new trading accounts for that, and you move your cash over into it, and you start trading, you can have mark to market in that entity from that point forward. And we would notify the IRS with the first tax return. But the idea is, matter of fact, it's a double blessing because you could say, let's say you get it set up by October 31st. We'll just use that. October 31st, you start trading in the let's say partnership, and from then on, you've got mark to market. So now you don't have to worry about wash sales, and you don't have to worry about that $3,000 loss limitation.
Okay.
The other benefit is that in your personal account that you've been trading in, that goes dormant because you're moving your cash over into the partnership. Once your personal account goes dormant after 30 days, any wash sales that have accumulated there turn into regular losses. And so now that account clears out. So it's really, you get a double blessing from both sides, and everything starts to work. So there's never, it's never too late to go ahead and set something up and get it going, because that transition there really just kind of clears everything out for people.
Now explain what a wash sale is, so people understand what it means. The definition of a wash sale.
Yeah, this is one of the dumbest things the IRS and Congress have ever come up with. But the concept, or let me give you the idea why. They noticed on the last week of December every year, people were dumping all kinds of stocks. They're losing stocks
Right.
to harvest the loss, and then on the first week of January, buying those same stocks back, and then
Right.
starting all over again. It's basically resetting everything. Well, the IRS noticed that was happening and decided to make up what's called the wash sale rule. And the rule states that if you sell a security at a loss, now it's stock, options, it's really anything in a ticker symbol. But if you sell a security at a loss and buy it back within 30 days. Remember, I just talked about 30 days a little bit
Right.
ago with clearing it out. If you buy it back within 30 days, and it doesn't matter whether it's the same stock or the same option, it could be a different expiration date, it could be different strike price, whatever. If you buy it back within 30 days, then the loss in the first transaction moves to the second transaction. Now that doesn't sound like a whole lot, particularly if you're trading rapidly. Okay, well it moved, a couple hours in time or a few minutes in time. But if you keep doing this, eventually those losses keep moving and they cross over December 31st.
Right.
So now if I've got, let's say I've got $100,000 in gain. And no, yeah, $100,000 in gain, and I have $20,000 of wash sales that are moving into, let's say, 2025. I now have to pay tax on $120,000,
Right.
and I get that $20,000 loss back next year, hopefully.
Right.
There's situations where you couldn't, or it keeps getting deferred until 2026, things like that. So that's what's called a deferred loss, and the idea is you pay tax now, and you hope to get it back from the IRS later. It's very problematic. With mark to market, you get rid of the wash sales, but it's a whole different way of accounting. You basically look at the value of your account at the beginning of the year, at the end of the year, and we compute an actual gain, and you pay tax on that, or an actual loss, and you actually write all that off.
Is that why you always get a lot of people that try to sell their stocks like on December, like November 1st, November 31st, or whatever number,
Yes.
the last,
Mhm.
because you got to do it within 30 days.
Absolutely. We have a lot of clients who either sell everything or stop trading. You don't have to sell everything, but stop trading on November 30th and don't do anything for December. And that's a cool month to take off. I mean, you got Christmas, you got travel and
Yeah.
stuff like that. So it's not bad. Just take December off and then everything clears out. Some of our clients also, they have a basket of stocks that they trade from January 1st to November 30th. And then
Okay.
once November 30th hits, all those wash sales have accumulated. They have a secondary basket that they trade in December. There's no overlap between those two. So in December, under the first basket of stocks, since those are not being traded after the 30 days in December, those wash sales clear out.
Hmm.
Now you've got started accumulating wash sales in December on that secondary basket, but if you go back to your original basket on January 1st, now you're not trading that secondary basket, and those wash sales clear out by the end of January. And that's one of the reasons brokers don't issue statements until the end of January or early February, is they've got to see if, like, on December 31st, you're dumping a stock, and then January 1st, you're buying it back because that's a wash sale that has to move. So
That has
that's,
to be right.
yeah,
That
you
has to
got
be,
that
has to be
30-day
recorded.
window. So that's going to happen, and so you got to clear about in January. So we've got a couple strategies there that actually help with that.
And that's why everyone here, when you're listening, what Jerry's trying to explain to you is that this is why you got to have somebody who knows what they're talking about, especially depending on how many trades you have. Because listen, some people are day trading, some people are swing
Right.
trading, and and investing. But I always tell everyone, Jerry, September, October, November are the best months to trade. December,
Hmm.
things start slowing down. Sometimes there's something there as an opportunity. That's why people
Right.
like day trading, because you're not holding a position. That would be
Hmm.
just more of an income in and out as a day trade. But you'll get a lot of action happening right around that November time, because people got to take care of that wash sale. Because I don't know about you, but I don't want to wait till the following year. I don't even
Right.
know. I don't even know if I'm going to be here next year. You know what
Yeah.
I mean? So
Absolutely.
I'm going to take my losses now. I don't want. I don't want, or my gains now. I'm like, whatever I owe, and you know what I mean. Like, I don't want
That's
to
a
carry it.
That's a really good point. Is getting what you can right now,
Right.
taking your losses right now. Goes back to also the expenses. If you're having the expenses and you're able to deduct them, let's get something back for them. Even if you have to use a Schedule C, let's get something back for them. It's a typical business principle of you have to increase your cash flow. You got to watch that cash flow, and it comes from two different areas. It comes from taking those losses and getting the tax refund, or deducting those expenses and getting the tax refund from that.
Jerry, I learned a very valuable lesson, and I think some people here that are listening have to understand this. And nobody likes accountants, and not in a bad way. It's just like
Like
it's just
lawyers.
Yeah, well, it's just an expense. It's like
It
I hate
is.
lawyers. They're the worst, but but they're expensive, and
Mhm.
the best lawyer is not is to have one, but you don't need it. It's like having insurance. Best
Right.
insurance is not when you have to use it. And the thing that accountants, some people are like, well, they're so expensive, this and that. I try to
Mhm.
explain to them, you know, at the end of the day,
Mhm.
they'll save you so much more money than just going to like an HR block. Like you can't go to an
Absolutely.
HR block and do this.
No.
They'll just go, oh, here's a sheet, and yeah, here's our, we charge you $400, whatever they want, you're done.
Mhm.
But
Right.
then you're like, well, why am I paying him 400? And when I could pay, I'm paying this guy 3, 4, 5,000, whatever it may
Mhm.
be. I'm just using a number,
Sure.
I'm not
Yeah.
of course that. They're like, well, listen, you own businesses, you have real estate, I mean, like you could write things off on one area to offset on the other.
Mhm.
They don't know that. They don't know you personally. And that's why you got to have the right accountant. Like even
Right.
me when I'm teaching somebody, Jerry, I
Mhm.
tell everybody, if you haven't taken training from someone, I'd rather you go learn from someone first, and then
Yeah.
why we teach and what makes us separate. This is
Absolutely.
why trading is like a 90% failure rate.
Mhm.
You got to learn. Go out there and learn it on your own, and
Learn the
try to
hard way.
figure out from someone else, and then you'll see why. The only way you become successful is you got to get mentored. You got to be trained. The same thing
Absolutely.
about accounting. Yes, like same thing
Yeah.
about accounting. You can't screw around with that. I mean, there's opportunities. You could save so much money. I mean, listen, you have these IRAs, you own your home and stuff. So it is very important, to have the right person for the right job.
Absolutely.
Don't ever look at that. Now,
Yeah. One of the things I cover in my webinars, and I've done it on yours as well, is that I've showed that if you set up like a multi-member LLC, an LLC partnership, and people look at that and say, "Oh man, I've got like, let's say a $600 tax preparation every year, and I've got an LLC fee in my state. I don't want to pay that. That's a lot of money." But I show on those webinars that how if you get the right accountant and pay for the LLC and you pay for the tax prep to be done, you're picking up that home office deduction. Remember, I referred to that a little bit ago. That alone will give you enough in refund to pay for those extra expenses. And so it
Mhm.
pays for itself in the long run. Uh, uh,
Right.
it's very much worth it. Plus, if you want to reduce your audit risk, it helps to have a CPA doing your tax return. It really looks good.
Yeah, you can't do this yourself. I don't understand. Some people, I talk to them like, "What are you doing? You're gonna get yourself caught, or you just, because I have some people ask me a stupid question, and Jerry, they come up to me and they say, "Well, wow, you guys did well today. I could do. I mean, how do you? I mean, like, but I got to pay taxes on this." I'm like, I always tell everybody, if you, and this is like, and I tell everybody this in my trading class. If you're paying taxes, that's a good thing. That means
Yes,
you're making money.
it
You know
is.
what I mean? If
Yeah,
you're not paying taxes, you got a problem.
I had a client about a year ago said, "I'm going to stop trading because I'm going to have to pay tax on all this. I'm making too much money."
What kind of
And I'm
question is
sitting
that?
here thinking, "Why?
Or
I'll trade positions with you."
I'm like, so you don't want to make anything and then not make I mean, like, listen, it's
Yeah.
that's part of doing business. And that's a good thing. So but the people know that, and I'll tell you where that comes in. They think from their account and they're like, oh, you're gonna be in a 50% tax bracket.
Mhm.
You're gonna pay a lot of money. And that's where guys like you come in that people understand. Are like, no, maybe you're going to have write-offs. You're going to be able. There's ways you could bring down that number,
Yeah.
but they don't know that. They always think like, oh, we're going to pay capital gains. You got to pay capital gains, and like depending on certain people in this world, like I know we have a lot of people here from Canada too.
Mhm.
I mean, do you do any counting in Canada?
No, everything we do is US based, but to kind of follow up with what you just said, whether in Canada or in any other country, the business principle is you follow the revenue first. You get the revenue and you worry about taxes afterwards. You don't worry about the taxes and then base your business on the taxes, because that's our society has gotten used to that, quite frankly, for whatever reason, that we set everything up revolving around the tax code, and that is a pure recipe for failure right there. You have got to, like like uh, like you mentioned a little bit ago, you've got to have your plan, and you guys emphasize this. You've got to have a strategy for trading,
Right.
whatever it is, and everybody's got their own little strategy. It tweaks a little bit, but if you start with that strategy and then you start worrying about taxes, you're going to screw that strategy all up.
Right.
And you've had people on here talking about psychology.
Right.
And you've got to set this down. You've got to set a plan down. You got to keep your strategy, but also in the strategy, you have to take care of the taxes, set everything up so it's properly taken care of, and you know what you're doing. And one idea that I tell people is that as you're trading all the time, you're making money, put some of the money back for taxes. Don't wait till the end of the year and you've got, $200,000 gain. Now you got to pay tax on. You don't have any money here for it. Put some money back for taxes, and if you don't use it, you can always put it back into trading.
Right.
But you've
Right.
got to plan for it and set things down properly.
Right. A question that came up a couple of people in here because I specifically more day trade and
Mhm,
more swing trade on the stock side. But is there advantage? Like I hear this advantage. People say, well, is there a different type of rules when it comes to like if you trade cryptocurrency? I know there's something with futures. I mean,
mhm,
people like, oh, it's got a great tax. That's why people like to trade it. I'm like,
right.
well, you got to make money first, so we'll worry about that later. But is there an
Absolutely.
advantage to trade a different exchange versus the stock market versus trading futures or crypto? Is there different rules and regulations for those?
Short answer, yes. And I'll go through each one of those. But um, somebody that's just looking at that and say, oh, this has got a better, this looks like a better tax structure to me than what I'm currently doing. You got to understand each individual person, each individual trader is different,
Right.
and you understand things differently. And if you're understanding things where you are, stay there. Don't go to something you don't understand because you may fail there. And so you're trading success for failure.
Yeah, I
So,
know a lot of people that failed miserably trading future. Future's a little
yeah,
difficult, and they're like, but they only trade it because they heard of the tax implications.
yes.
They're pretty good, and I'm like, that's not a really good strategy. You know what I mean? Like,
And
that's
yeah, and that
gonna
goes back to the point I was making a little bit ago. Don't make your strategy centered around the tax code.
right,
You go where you have your strengths.
right,
So, okay, stocks and options, those are typical. We're familiar with those. If you don't make the mark to market elections, capital gains or capital losses, you got the $3,000 limitation. Mark to
right.
market, everything's wide open. Let me talk about Forex real quick because Forex is really unique because it's very similar to market, but you don't have to make any elections. It goes as other income. So if you make 20,000, it just goes as 20,000 as other income on your tax return. If you lose 20,000, you write it off on your tax return as other income. It's really simple. Probably the simplest of all of them.
Why they do that? Let me say, not to cut you off, or and I'm glad we're going into this. Why is one exchange have the tax benefits that way, where it's not just across the board?
I don't have a solid answer for that. I've got a suspicion that it has to do probably with lobbyists.
Okay.
And the way the tax code is structured, it has more tax code is more dependent or more a result of lobbying than it really anything else, quite frankly.
Okay.
Cryptocurrency, cryptocurrency is like stocks without the mark to market election. It's going to be capital gains, capital losses, limit to 3,000 a year if you lose money.
So crypto's the same as stocks.
Yeah, pretty much
Okay.
without the mark to market election. Yeah.
Okay.
Now, futures, you've mentioned that futures have a uniqueness as well. I like futures, but they're difficult to trade. Futures, you cannot make the mark to market election on. If you lose money in futures, you're limited to 3,000 a year.
Okay.
So,
Same thing as stocks.
I always tell my clients, if you're going to lose money, go mark to market on the stocks and options. Do that. But if you're going to make money, futures is the way to go because if you're making money, there's a split between what you make. There's 60% of what you make is a long-term capital gain and 40% is short-term. Now, that's significant because long-term capital gains, the tax rate is capped at 20%. Can't go above that. And most
Okay.
people will fall into 15%.
Okay.
So now what you've got is you're making 200,000 a year, let's say in futures. Um, 60% of that or $120,000 is now being taxed at 15%, possibly less, but probably about 15%. So you just saved a whole bunch of money on the taxes there.
Okay.
Now, we have to be careful here and just I got a note here. There are certain ETFs that are traded that look like stocks, but they actually get treated like futures. And every year we have clients get surprised by this. The biggest one is SPX. Everybody out there says, oh, SPX and SPY are pretty much the same thing. They look alike. They got different prices, obviously, because they're structured a little bit differently.
Mm-hmm.
But the difference is based on where they are traded. SPY is traded through New York, so it acts like a typical stock. SPX is traded through Chicago in the
Okay.
commodities exchange, so therefore it acts like a 1256 contract,
Okay.
futures. So that's people get caught off guard by that every year, and so I just want everybody to understand that there are a handful of ETFs that act like futures and get taxed that way.
But it's like a stock. You're trading an ETF like a stock, but because it's not, you're trading an ETF,
Hmm.
and that ETF is going to be taxed as a future than a stock. You're saying.
That's correct. Yes.
Okay. I said that I didn't know that. Now I know. So I guess a lot of people wonder why they want to trade one ETF over the other.
Yeah, exactly. Now, if you're making money with SPX, then that's great for you because now you got the 60-40 split and you're saving all kinds of money in taxes. But if you're losing money, SPX is not the place to be because you're going to have problems.
Okay. Wow. All right. Um, I had a question that came up. Somebody emailed me, one of my students, and was asking me about about what's going to happen in the future. Now we're going to an election, and
Mhm.
obviously you have two different. You have Trump and Harris have different ways of how they want to change the tax code.
Right.
One of the things I was concerned, as someone was asking me, that if Harris gets elected, she wants to do something with the future capital gains. You know what I'm talking
Mhm.
about?
Yes.
Okay. Maybe you
Um,
could elaborate a little bit, everyone here, what exactly that means, because like I think I understand it, and I can't see how that could actually even work or how you even track that. But
yeah. Well, I'll tell you how you track it here in a minute. But actually, what they're proposing, and Biden proposed this here earlier last year or earlier this year, I can't remember which, but it's basically taxing unrealized capital gains.
okay,
Essentially, that is sort of the mark to market election. Now, I don't want to turn anybody off from mark to market election because there's ways to structure it and not have unrealized gains in there. But what they want to do is basically if you've got long-term holdings, you've been holding the stock for, let's say, 10 years, and it's appreciated considerably, they want to take that appreciation and tax it now. And go ahead.
so basically, it's like, let's say you own a house, it's worth 1 million, right? And now it's worth 2 million, but you live in it.
Yeah.
They want to start taxing you on the $1 million profit on your house that you didn't even sell yet.
I have not heard them refer to that in terms of property such as that, but I have
Well,
heard
even
them.
property. I'm kind of
Yeah.
just using that kind of a
Example.
metaphor so everybody
Yeah.
understands what we're talking about. You know what I
Absolutely,
mean?
because there's a lot of capital out there that people have been sitting on for decades that they haven't sold, that's appreciated, and they're waiting to pass it on in their estate or possibly waiting to retire on and pay the tax at that point. Well, this administration or potentially the next administration wants to go after that. They're going to, and frankly, from what I've seen in other discussions, they need money, and they're going to come at it from however they can get it. Don't forget in the background those extra IRS examiners that they're hiring. That could become a problem within the next year as well.
So how's that work with an IRA? Let's say I have an IRA. I worked my whole life, 10, 20 years, right? I build up this account. We're trading it. I worked my whole life, right? Are they
Yep.
going to, and now all of a sudden I'm able to take that money out. Let's say it's worth, I put $1 million into it.
Hmm.
You know what I mean? And then
Yeah.
finally now I can live off it. They're going to tax me on the $1 million that I was already taxed on.
Well, if it's a traditional IRA, it gets taxed when it comes out anyway
Right.
because you got the deduction, so it was pre-tax dollars. In a Roth IRA, it's very possible.
The
Again,
Roth IRA.
I haven't heard any comments on this, but I think it's possible that they could start coming after that appreciation because that in a Roth IRA, just to kind of reiterate, you take already taxed dollars, put it aside, and you start building up. So anything you earn in that Roth IRA doesn't get taxed. And so when you pull it out at retirement, there's no tax liability on it. But again, you've got an unrealized gain there, and it's very possible they may start going after that.
Okay, I still don't understand what, like you just said. Other than
Sorry.
no, I get it. I just don't understand why they would do that, other than that they're trying to get money
Yeah.
anywhere. But I could see that really crushing the stock market. You know what I mean? Like everyone's not going to want to hold their stocks.
I agree with that. I think once if they ever go to taxing unrealized gains, you're going to see a massive downturn in the stock market because everybody's going to dump everything. Nobody's
Well, it's
going to
not
hold it.
just the stocks, Jerry. It's also, it's people. It's going to kill the entrepreneurship in a
Yes,
way, because people
absolutely.
people own a business, and they built a business, and they'll never be able to make it grow, and they'll just sell it to someone else, maybe overseas or whatever. So they have to
Mhm.
pay the tax on it. They're like, listen, I built a business, and now the business is worth X amount of money, and now going to tax me on it. You know,
That's a great
so I
point.
mean, on the positive side, they got to go through Congress anyway to try to pass that
Yeah,
anyway. So that's the positive side. But
sure.
I just don't understand, how do you like take my house that I've been living for 20, my whole life, and now you want to tax on it that I didn't even sell it yet.
Yeah.
And the other thing is, what happens if it depreciates? Do I get that money back from them?
No. And that's the problem. Yeah, so you've got all kinds of things here going on and questions that aren't necessarily answered at this point. And I don't like I just don't like the tone in this where they're going because you're right, it's going to depress every market, whether it's not just the commodities or the equities markets, but also your housing markets and like you said, businesses out there because when you sell a business, that's a capital gain as
It's
well.
capital gain.
And so
Yeah.
yeah, they're going to have to people start have to planning for that. And then once again, you're forcing people to plan their lives around the tax code
Right.
and it's a recipe for failure. Uh, uh, I'll just give you an example. If you ever want to look at what's going on, look at California because they're going to where they're starting to tax everything that moves, and people are fleeing the state. The economy there is not doing really well, and just kind of keep an eye on California. You see what would happen in the United States.
Okay. Yeah. I mean, that's why people go state to state,
Yeah,
and it's listen, I really haven't seen any big changes in the taxes with stocks goes, but like that was just something that I didn't really make any sense to me, especially been doing this for 30 years. Like how am I going to trade and hold these long-term trades and they tax me on it because they go up and they go down.
yeah.
You know what I mean?
And
So like,
the way that would do. I'm
and
sorry.
people don't have that money. I mean, like other than they
Yeah,
have to sell it, they would literally have to sell it. And that's what I'm saying. The stock market will crash because if you have to pay taxes on it, you're not going to want to hold it. I'm like, okay, well, I got to sell it
yeah.
and pay my taxes on it.
And so
And that's what
essentially, in that case, everything becomes mark to market. You
mark to
take a
market.
value at the beginning of the year, value at the end of the year, and bam, you pay tax on it. And of course, you probably won't be able to write off the loss if it goes down, but yeah.
Because
So
you only have to write off $3,000.
yeah, exactly. So yeah, there's all kinds of questions here that still remain to be answered, and this could be a disaster for the economy.
Yeah. Um, well, with that said, regarding about, is there anything else that you might could advise everyone else regarding about any future things that are coming out? Anything you heard that's coming out regarding about preparing on tax wise, and that could help them, or what they need to look forward to, or
Mhm.
should be looking out for?
As far as legalities with the tax code, I don't see anything on the horizon because everything is kind of in a holding pattern right now with Congress until after the election.
Okay.
Now, you may start to see some scurrying around some things with December, but that a lot depends on how the election turns out and who wins what and all that. As far as planning for investors or your traders, I would say get a plan laid out as soon as possible.
Hmm.
I consult with clients all the time, and they ask me, should I wait till the beginning of the year or do it now? And I talk to them a little bit because there are some cases where I just say wait till the beginning of the year because it's really not going to make a lot of difference. But people who are trading very heavily, it's usually a good idea to go ahead and get a multi-member LLC set up so that you can go ahead and get that transition this year. You get part of the year as mark to market, and you really reaps a lot of the benefits. And you
What does
get
that cost? Just out of curiosity, because people have to understand. Because money, I mean, what is it usually to start that up?
And I'm going to be honest with you, I don't have that information because I don't keep track of our pricing stuff. But if they
Okay.
want to go to our website, tradersaccounting.com. That stuff is on the website. I know.
Yeah, let's post that link up for everyone here. If
Yeah,
anybody wants to get a free, there you go. That's the book. You got the link right there. That's the
yeah,
book
there you
right
go.
there. If anybody wants it, just can click on it, and you go to the website. You actually could get, if you want to know more about Trey's accounting,
Price
definitely.
quotes. Yes,
Yeah,
absolutely. And we can set up the LLC for you. We can do the bookkeeping also if you like. And then, of course, the tax returns, full service tax return.
right, right. Um, I mean, I don't think I've seen anybody had any questions here that want to, because we're almost out of time here. Want to catch up. Anyone has any last minute questions?
Sure.
Um, Other than everyone's thanking you for being here.
Well, I get that a lot, but it's great because people need to start planning now because we're running into tax time next year, and so all of this stuff has to be. You got to start thinking about it now, not wait till April 15th of next year.
Yeah, I mean, it's never a good time, and it's just everyone
No,
gets scared talking to accountants because they're like, "How much money do I have to owe?" Like, what I got, like, like what's involved. They get nervous, but
yeah,
listen, they're your friends. You know what I mean? They try to do the right thing. They say, "My accountant saved my ass so many times."
yeah.
I mean, and I
But
would
let me put it
probably
this way: if you don't do well, then we don't have you as a client anymore
right.
because you went belly up in your business, so we just lost an account. So really, it's in our interest to help you do well.
Now, there was a question here from Lynn. She said, "I'm curious. C2s are That's a good question right there. I can read it. C2 student here buying and selling gains and losses on the same stock every day. Are they hitting a wash sell rule all the time or have already elected market to market?"
You would, if you have not elected mark to market with the IRS, then you are hitting that loss sale rule every day, and those losses are moving. Now, that's not to say that everything is going to move into 2025, because in some cases those wash sales will resolve themselves because in the next, let's say on the next trade, you make a profit that's enough to take out that wash sale that moved to the second transaction. It's done. It's over with. But if you're borderline and you're losing money, or there's something, a stock that's you're losing money constantly to get into a better position, it's possible you may be accumulating a lot of wash sales.
All right. Alan has a question that came across. Is equipment such as computers, monitors are deductible for day trading and on a personal basis?
Yes, absolutely. You can deduct them on your personal return. You can also, if you form like a multi-member LLC, you can put those into the LLC and we can deduct them there as well. It's a little bit easier to do there. And by the way, the difference between a multi-member LLC and an S corp, I didn't mention that. An S corp, you are required, the officers are required to pay themselves a salary. So you need a payroll company and you need payroll checks, things like that. So that's why we recommend really the multi-member LLC, the partnership LLC, because it's very simple to work with and simplicity is your friend.
What's a good amount of money? Because obviously you don't want to go out there and just open an LLC, just open it up to start the business. But what is a good number of profits that you should make before you should consider doing an LLC
Um, I'm going to redirect that question because I don't think it's necessary that you have profits. I think if you're
or
even if you're
losses? Okay,
I think if you're trading and you are doing a significant amount of day trading, then I think it's important to go ahead and get it into that
just
multi-member
have it up there.
LLC.
Okay, makes sense. Okay, no matter what it is.
Yeah.
Woodstock has a question right here for you, Jerry, and he says, "Do I need to wait for the funds in my S corp or member LLC after I form either?"
Um, yeah, what you'd have to do is you have to form the S corp or the multi-member LLC first, because that's going to get you the EIN from the IRS. So basically, the EIN is your business social security number, if you will. Once you've got that, then you can set up your brand new trading accounts and then start funding those and get that going. But you got to have that EIN first.
Okay, all right. Anyone else have any other questions? I don't see any more coming across. In the meantime, yeah, doesn't look like, but everything looked like great questions came across. All right, Jerry. Any last minute advice that you want to give everybody? Any good books to read? Any good movies to watch? You know,
Books to read, quite frankly, there aren't any books to read on this that I know of because everything there aren't that many people familiar with like mark to market and things like that. So really, just kind of beware and beware of what you're reading and make sure that it's good. Movies, I don't get to watch movies very much right now. I'm still working 10 hours a day, so uh, uh,
Typical accountant.
yeah,
Typical
my
accountant.
wife will start watching TV at night, and then I'll just fall asleep.
And she'll give you the cliff notes on it in the morning.
Exactly. So
Alan, this will be recorded. So if you want to know more about the LLC and what it is, like I said, this is going to be, we'll have some shorts on it. We'll have this posted on our podcast channel and everything else. So just watch it again. So we did spend a lot of time talking about it. I don't want, regarding about LLCs. So go from there. But with that said, listen, Jerry, thanks for coming here. It's always a pleasure to have Traders Accounting
you're welcome.
coming to speak to everyone here and tell them a little bit about what to expect, what to prepare, why to do it, why you need to have the right accountant. And for everybody here, if you want to know more about Traders Accounting, we just post a link up there right on the screen. Definitely check them out. Definitely read their ebook, get a little bit more about it. Know your accountant a little bit more and realize, is he the right fit or he's not? Because listen, if you're doing it in a business, you got to have the right person for the right job. All right.
Absolutely.
Thanks a lot for coming here, Jerry. Thanks for everyone listening.
Thank
And we'll
you.
see you next week we'll see you next week for the other